Hi, I'm James Robinson, and this is my stock pick of the week. Today we continue on our series on Raytheon Technologies, symbol RTX. This is the final section. We'll be talking about wealth creation. And just to give you a sense, I consider wealth creation the things that the management does that enriches the shareholders. So the company makes profits through their operations, that's great. They manage risk, and that's on the balance sheet. But what do they do with those profits? They can keep cash, they can retain earnings and reinvest in the company. They can buy back stock, they can pay dividends, they can reduce debt. All of those things create value for the shareholders directly or indirectly. And so what we do in the wealth creation, we just look at what the company's done in each of those categories and how that's benefited the shareholders and how it's like to continue to benefit the shareholders going forward. So the first category we look at, and a category that's most often used by companies, is share repurchases. The reason share repurchases are used is because they've got advantages for the shareholder and they've got advantages for management. For the shareholders, it's a tax-free way of increasing my wealth. What happens is if I owned 10% of the company, so there's 90% of the shares outstanding, if the company bought back 20% of their shares outstanding, that would increase my ownership in the company by 20%. So now I'd go from owning 10% to 12% of the company. As a result, there would also be fewer shares outstanding, so the same amount of total dividend dollars paid would be paid to 20% less shareholders, so we'd all get a little more money. The earnings per share would increase since there's less shares, and since earnings per share is a measure of profitability that many stockholders look at, the price of the stock is expected to go up. Best of all, from the shareholder's point of view, it's a tax-free way of creating advantage because I didn't receive any cash, so I don't have to pay taxes, even though the value of my investment has probably gone up. Management likes it because if they continue to make the same amount of money every year and they buy back stock every year, it looks artificially like they are making more money because the earnings per share will go up. The same thing with dividends per share. So management likes it and the stockholders like it, and so it's what you see all the time. So here you see the shares outstanding for Raytheon. You can see that starting in about 2005, they've pretty consistently gone down every year. Not a lot, but a little bit. And that trend is continuing. And this is obviously a really good sign. We like that as shareholders. And so the first test they passed in terms of creating wealth for shareholders, buying back stock, and they've done a good job of that. Let's look at those same charts through a different prism. So if you'd owned 10% of Raytheon at the end of 2019, that would have meant you owned 39 million shares. Today, through stock repurchases, if you never bought a share and you never sold a share, so you owned the same 39 million shares, your ownership of the company would have gone from 10% to just under 14%. So it'd be about a 39% increase. So you'd own 39% more of the company, even though you never invested a penny. And despite the fact that during that time you were paid dividends most of the time you owned it. Even better, during that time, your share of the company's earnings, so if you own 10% of the company, you theoretically are entitled to directly or indirectly 10% of the earnings. So your share of the company's earnings would have gone from $193.5 million to $466 million in those same 10 years. Looked at another way, your earnings per share would have gone from $4.96 a share to $11.94 a share. So these are all really good things, and you can see how the power of buying back a little bit of stock every year over a long period of time really does accrue to the benefit of the shareholder. Stockholders' equity is a measure of the total assets of the company minus the total debts. It's an indirect determinant of the value of the company. Not many people buy stock because of the shareholders' equity, but if the company has managed to increase its shareholder equity every year, that's a good sign. And if they're not able to do that, that's probably a bad sign. So it is one of the things that I look at. And you see since 2012, the shareholders' equity has gone up virtually every year, and shareholders' equity per share has gone up faster as we reduce shares. That's even more impressive when you think about it, the fact that the company has bought back almost 40% of its shares in 10 years. And while doing that, they've managed to increase the net value of their assets minus their liabilities. So that's actually really, really well. So that's another determinant that this company's management is doing a good job of enriching us, the shareholders. One of the things that I look at as a shareholder is, so let me backtrack. It's axiomatic that it takes money to make money, right? Everybody sort of recognizes that. The question as an investor is, how much money does it take to make money? The ideal investment is one that you don't have to spend very much for and you get a huge return. The rotten investment is one where you invest a whole bunch of money and get a very little bit of return. So return on assets really just looks at that. What are the total assets that this company is utilizing in its operations? And how does that compare to the amount of income or earnings that the company has made? I like companies that are at least in the top 25% of other companies in terms of their ability to generate earnings, return on assets, I should say. And you can see that this company has been in that level or above since 2007. You can also see it's been very, very consistent. So they've done a nice job of consistently earning the same amount of money. You can see the last 3 years, the return on assets has gone up, and it's, in the neighborhood of, about probably 10 or 11%. I haven't looked at it exactly, but it looks like it's about 11% on this chart. So again, I think the stock is undervalued. I think they do a good job returning wealth to shareholders. I like the dividends. I like the operations. If I liked all of that and this return on assets was very, very low, I wouldn't buy this stock. This is one of those things, sort of a go, no go kind of thing. If it's at the right level, then I'll buy it, and then it's still under consideration to buy. If it's below a certain level, I almost can't imagine that I would buy it. So return on assets really matters, and this company does a better than average job. And taken in the light of everything else, it continues to be a buy for me. Some people like to look at return on shareholders' equity instead of return on assets for the same analysis. I typically don't. So return on shareholders' equity is really, it's the total assets minus the total debts. And that is the amount of, sort of actual money that the company has invested in the business. The problem is that the debt component of that, to me, equates to risk. And you can get fantastic returns on equity if you just lever yourself up and have tons of debt. And that makes all the sense in the world until it doesn't. And when it doesn't, you go bankrupt. And I don't want my investments to ever go bankrupt. And I'll sacrifice a few percentage points of return today to guarantee I never have a bankruptcy event. So that's one of the reasons when you look at the stocks that I suggest you buy, they very seldom will be in the top 10% of companies in terms of return on shareholders' equity, even though they're often in the top 10% of companies in terms of return on assets. There are other people who look at this the other way. They're just not as risk averse as I am. But I like to say, I like to buy companies with no debt if possible. So this company, having said all that, has some debt, but very little, and is basically performing as well in terms of return on shareholder equity relative to the market as it is in terms of return on assets. So that's great. I love that. That makes the company even more attractive to me. And it's one that I'm happy to suggest you should buy. So I'm announcing today my new goal, which is I'd like to get to 1,000 subscribers. For those of us that have these channels, look, I've grown pretty well. I started obviously with no subscribers, and I get more views in an hour today, some hours, than I would get in a week when I started this thing. And I know it's a snowball, and I know it's picking up speed, and it's getting bigger and bigger, and that's great. And I'm appreciating watching it grow. But I'd love it if it would grow faster, right? If we can get the snowball bigger sooner, it grows bigger faster. So I'd really appreciate it if you like these videos. It doesn't cost you anything if you just subscribe, if you hit the like button. If you comment, that would be great too. I try and respond to all my comments. If if you really like the videos or you've made money off some of the investments I've suggested, just drop me a line, put in the comment section what city you're in so I can put you on a dot on the map. Finally, real-time information. If you want real-time information on my trades, you probably want to follow me on Twitter, because I always announce on Twitter when I buy or sell a stock. I don't always get time to make a video. Life gets in the way. These videos take a bit of time. So it's often a week or two between the time that I buy the stock and I put out the video. But on Twitter, you'll see right away. The same thing goes for selling a stock. If something goes wrong and I want to get out of a stock, I'll immediately tell you on Twitter, but I won't necessarily tell you in a video. I just don't have time to do that. So if you want to stay on top of things, that's the best way to do it. Also on Twitter, I'll post updates on when new videos are posted and or give you thoughts on the market and the stocks in my portfolio as things arise that are important. Thanks. One of the least understood things that a company can do with its earnings is to retain those earnings. When a company retains those earnings, it just means that they're not paying it out to us, the shareholders. I don't have a problem if a company does that if they demonstrate to me that they're utilizing that money efficiently. And what I mean is they're using that money to make more money. Now, there's no easy way to measure that, because you don't know what they've done with it. You don't know where they've invested it. Have they paid off debt? Are they buying subsidiaries and those turn out to be bad investments or fantastic investments? There's no real way to know. So what I've done is come up with, I don't know if it's my own shorthand, but logically what I think makes sense as a shorthand, which is simply to say, how much total money did you retain in the last 10 years? And how much did the earnings go up in the last 10 years? And I'm giving the retained earnings 100% of the credit for the increase in earnings. Now, I know that's not exactly accurate, and there could be a whole bunch of things that contribute to the fact that there's an increase in earnings that have nothing to do with the amount of money that's retained. But I'll take my chances. I'm looking for something that gives me a sense that this is what's going on. So the first thing I do is I look at the retained earnings, and I'd like the retained earnings to be relatively flat year after year after year, which this is. The red line is how much they're keeping for retained earnings each year. That's not going up, even though the earnings are going up. That shows me that they're not needing a bunch of additional capital to grow their business, and I like that. And obviously the retained earnings total is the just amount of money that they've accumulated through retained earnings over history. That's not as important to me as the year over year amount that they're retaining. And this company is very, very flat, really going back to almost 2005. I mean, it's actually pretty miraculous that they haven't retained more money relative to what they did in 2005, just because they're such a larger business now and, inflation. So that's a really good sign, and I'm very comfortable with this company's retained earnings. And because I'm comfortable retaining so little money, I'm not as concerned with the results that they're getting off those retained earnings, because there's not a lot of them. If they were retaining a ton of money, I'd really want to see the income growing up significantly to justify that. This chart is, what I was talking about, which is the return on retained earnings. They take 10 years of retained earnings, I compare it to 10 years of earnings increase, and I say, what kind of return did we get on that? And I'd like it to be 10%. It's an arbitrary number, but it's just the number that I've chosen. And you can see that for the last few years, they've managed to get a 10% returns, a couple of years where they didn't. But in the aggregate, they've done pretty well in terms of creating income off retained earnings. When you couple the fact that they've done pretty well, and you couple that with the fact that there's not really been a ton of retained earnings in the first place, you say, okay, the retained earnings for this company under problem. Let's continue on with the analysis. Another thing that a company can do with their retained earnings, or with their earnings, I should say, is to keep it in cash. When a company has cash on hand, that has lots of benefits that are what we'll call indirect benefits to the shareholder. In theory, it's money that can later be paid out to us, and that's great. It's also money that means when something goes wrong, we don't have to borrow money, especially because when you tend to borrow money when things go wrong, it's more expensive. It means they have the ability to do acquisitions very quickly without going to the capital markets to raise money. It means that they have the reserves to expand or grow or do whatever they need to do. So I don't mind if a company retains a little bit of cash, and this company's done a pretty good job of that. Since 2004, they've gone from less than $1 billion to, let's call it $4 billion of retained earnings. It's not a tremendous increase, but it's a nice increase. Since 2015, again, they've gone from, let's call it, $3 billion to $4 billion. So in the last 5 years, they've saved about $1 billion. We'd like to see what they're doing with that cash, but that kind of goes back to the return on retained earnings that we saw in the last slide. But long story short, increasing in cash, in theory, means sooner or later they got to do something with that money. And one of the things they might do is pay a special dividend or buy back a bunch of stock at an accelerated rate. So this is it's just a savings plan, and I like that the company's doing it. Now let's look at total wealth created. So again, we've talked about the number of things that a company can do with their profits, and they're not going to put all of their profits into dividends, or all of their profits into cash, or all of their profits into buying back shares. They tend to take a slice and do this, and a slice and do that, and a slice and do the other thing. And we like to see how that kind of adds up. And in any given year, those slices will vary. And so I like to see how that's happened over some period of time. So you can see that I've got a line here for what's happened with the annual changes in debt. I've got a line here for dividends, a line for stock buyback, a line for increases in cash. Then I've got the total wealth created for that year. And then I've got what's happened over the previous 5 years in that category, which is the line in orange, which is the line we should be most concerned with. And you can see this company has done an excellent job in creating wealth for the shareholders when you look at how they're combining changes in debt, changes in cash, dividends, and stock rebuybacks, as well as increases in cash. So again, this is one of the things that makes me really believe that in the long term, this company is going to create real wealth for us. Some of this shows up in the stock price because they bought back stock, for example, and some of it doesn't show up in the stock price. In fact, some of it, well, for example, paying dividends or paying down debt doesn't directly show up in the stock price, but in the long run, having a company that's debt-free is a benefit, and it will increase the value of the company. So that's sort of it for, and a look at the wealth analysis, or wealth creation for a Raytheon company. Now, the next slide here is tracking my own portfolio, so sort of my own wealth creation. These are the stocks that I currently own. You can pause this and see, when I bought them, how much I bought, what's happened to the stock since I bought it. I caution you that the line at the bottom, the $1,800 of profit and 1.23% return, is cumulative, including all of the stocks that I own, including stocks that are no longer active because I don't own those positions anymore. I'll have a slide in a second that talks about what those slides are. So you can take a look at this. Some of our investments have done very well. Most of the things we've held have done very, very well. It's because I bought them at the bottom. They're very solid companies. I'm very happy to have bought these companies at these prices and think they're going to continue to go up. But my return on investment, that 1.33%, obviously lags the S&P by about 2 or 3% when I'm doing this video. That is, I'm not happy with that. I don't like falling behind the S&P 500, but the reason for that is that I was really heavily in cash for a lot of the year. I'm currently 46% cash. In April or May, I was probably 75% cash. And the logic behind that was the pandemic was raging and I didn't know what was going to happen. And I didn't want to get, crushed by the market. And so I was willing to go into cash. Now I knew when I went into cash that if the market went up, I'd underperform the market. But again, I'm very risk averse. So I said, I'm going to make sure that I don't, have any bankruptcy events in my portfolio by having too many stocks when things really go bad. And I'll take a little bit less return on investment to do that. And over the last 4 or 5 months, I've been slowly adding to positions. I bought stock in Raytheon and Value Line and in Altria, and I've been increased my positions in T. Rowe Price, and I bought 1 or 2 other positions. And so I'm getting back to fully invested as I become more confident or as I find fantastic purchases. But, it's going to be really hard for me to outperform the S&P 500 when I'm 50% cash. That means I have to effectively get twice the return of the S&P 500 to match the return, because my return is based on the entire portfolio, including the cash portion. It's not based on just the stocks that I've got invested. Here you can see a list of all of the stocks that we've owned throughout the year, including the closed positions. There's some nice big gains and there's some really big losses in these. Again, that was stocks that we tended to own as the pandemic was coming, and stocks that I got out of because I felt like it was, potentially we had a ton of exposure. But in the balance, even including some of these big losses, I'm so positive for the year, which I'm happy about. Still have good prospects to continue to make money for the rest of the year. And, sometimes you got to take your lumps and you just got to make a decision. And that's what I did this year, and I really don't regret it. So that's my results so far this year. I still have November and December to see if I can catch the S&P 500, which I'd like to do. And that's where we are. Thank you very much for your time.